We are live. Awesome. Well, hey everyone. Thank you all for joining our second panel of the day. We have quite an incredible group of investors here who are going to be talking about the investor outlook for DeFi in 2023 and beyond. I'm Alex. I'll be the moderator for today. I lead business development at Sushi. We have quite the lineup of investors here, so I'll just kick it off with short introductions for everybody. Just given that we're all remote, I'm gonna give Jared, the head chef, the duties of being the first introduction.
Hey everybody, it's great to have you all here and get insight from the big players in the industry and how you guys see the landscape of DeFi moving forward. I'm Jared. I'm the head chef at Sushi. I'm just gonna kind of end it there so we can go through the group that we have here.
Awesome. Jason, you want to go next?
Sure. Jason Stone, aka OXB1. I think most people in the crypto sphere know me. Started the first stake as a service company in America back in 2017. Founded the DeFi group at Celsius, left in March 2021, and most people know the story from there. Now I've just been working on family office stuff and advising what I'd call the NFT DeFi space.
Great. Mark, would you like to go next? I'm just going through the squares.
Yeah, for sure. So Mark Weinstein, joining partner at Mechanism Capital. Been in the industry since 2017 full-time. Used to work at Wade Financial with Avi on this panel, leading venture investments there. We started Mechanism in 2020, just around the time of DeFi summer. Most of our early venture investments were in DeFi. We probably invested in 30 plus protocols at this point, specific to that trend. Been doing it together for 3 years now, and still really excited about where DeFi is going to take us over the coming years.
Great. Avi, since you were mentioned, you want to go next?
Yeah, sure. Thanks. So I'm Avi. I'm a general partner in Golden Chain, which is a subsidiary of Golden Tree, which is a $50 billion asset manager. Golden Chain is our vehicle dedicated exclusively to the crypto markets. I've been in crypto since 2017. As Mark mentioned, used to work with him at Wave Financial, and prior to that, I was a co-portfolio manager of Block Tower, which is a liquid fund in crypto. So also big supporters of Sushi Swap here at Golden Tree. So
yes, we're big fans. Ida, do you want to go next?
Sure. Thank you for having me. My name is Ida Gao. I founded a fund called Shima Capital, which is focused on early stage seed, pre-seed, and crypto. We do a lot of DeFi, a lot of gaming, and everything between. Prior worked at a large VC fund called NEA. Tried to do a lot of crypto deals there, starting in 2016-ish, 17, but couldn't get anything through the partnership, so left and started a couple of crypto funds. So happy to be here.
Amazing. As a former VC myself, I definitely love the move into the more degen side of VC. David, would you like to go next, and then Steve, round us out?
Sure. So I'm David Duong, head of research here at Coinbase Institutional. I joined Coinbase about 1.5 years ago after spending 17 years in traditional finance, where I was covering emerging markets, rates, and FX. Right now, I am concentrated on covering like market views, macro drivers, tokenomics.
Oh, Steve, you're muted.
Sorry. Yeah, hi, I'm Steve Goulden. I'm head of research at Cumberland DRW. I've been there for about 2 years, and prior to that, I was in equity research for around 15 years on buy and sell side, most recently at Deutsche Bank.
Amazing. Well, thank you all for being here. I know everyone watching this video is super excited for us to dive into things. As you know, kind of having worked in the VC space myself, you know, having seen this space evolve from 2017 to now, with so many different things happening, you know, it feels like every year in this space has been quite transformational. So we know that 2022 had quite a year, especially for DeFi. We had, the macroeconomics and geopolitical things aside, there are quite a number of large failures of centralized finance and also large failures of decentralized finance. So moving into 2023, how are you all looking at, what is the current outlook for DeFi? How is that going to change over this year? And if we were having this conversation a year from now, what are kind of some of those changes that you would have expected to see or that you're most excited about seeing in DeFi throughout the next year?
I think that one of the real kind of macro changes versus kind of like previous crypto environments is clearly on the one hand, obviously higher rates and inflation has been bad news for crypto, but on the other hand, now you're increasingly starting to see products coming into the space that give investors access, on-chain access to kind of, TradFi risk-free rates. So like you're starting to see kind of on-chain treasury products, right? And I think that's super interesting when you can kind of combine that with, the ability to say mint, Go or maybe Curve USD at probably sort of like low single digits, right? So then that allows for kind of yield plays where maybe you could mint at 2 or 3% and put it into, the 2-year rate is now 5%, right? And so you can make that spread. And because it's such a low risk trade, low risk in terms of the collateral, but also low risk in terms of the yields, then you have the ability to do, levered yield farming strategies, right? But at far lower risk than you would have been doing similar kind of strategies in the past, right? And so what does that mean? I think that means that, or that's certainly a very fertile ground for institutional capital to come in and start doing, maybe 10x levered is a bit degenerate, but like, could you do like 3-5x levered if you're able to make a sort of 2-3% spread on each leg, and maybe the Aave stablecoin wants to get some serious market share, and so therefore keeps rates low. So I think that's super interesting. So you could get this kind of institutional quality DeFi coming into the space to take advantage of kind of higher quality opportunities that you haven't really had yet. And that, I think, could be a massive game changer and a kind of a symptom of high rates that I don't see people talking about that much yet, but I think that's kind of an interesting trend for this year.
I think you're completely right. And I think that what goes along with that is the general institutional interest in actually lending against anything, I'd say. So whether it's like crypto tokens or tokenized RWAs, real world assets, we're starting to see, an actual interest from, real institutions, whether it be, Point72, Apollo, JP Morgan, these institutions we're starting to, I think, willing to lend at, 5, 6, 7, 8, 9% against things that are, tokenized real world assets that actually effectuates kind of an ability for people to start utilizing their holdings or their wealth in their everyday lives in a similar way that we in crypto use NFTs or crypto coins as like collateral in DeFi, right? So if we can start to bring about a convergence of having more of these real world assets be day-to-day or for the things that we own and have to have day-to-day impacts in our lives because we have access to rails to unlock collateral or capital from that value. I think that's like the DeFi 3.0 summer, and I think that what JP Morgan's doing with KYC, AML, enterprise blockchain is really important. I know, Coinbase has started some rumblings of, they may be doing some enterprise DeFi in their L2. I think that that's really the next trigger for for the next run, in my opinion.
Yeah.
Yeah, I'll riff off that for a second there. I think what we're seeing happen right now is we're actually seeing applications be built in a way that are very, very, very user focused, because that's generally what tends to happen during low periods, during periods of lack of interest. Is you can start to shift your focus from building for the short term, capturing users over the next month or the next 2 months, to thinking about how am I going to capture the next wave of 10,000, 100,000, million, 10 million users that are going to come into this space, and start building for those people. And those people could be retail, those people could be institutional. I happen to think it's going to be both. And so what I'm seeing right now happen in the DeFi space is a lot of that long-termist thinking, which I think is going to lead to better applications. It's going to lead to easier use. And I mean, you're seeing this right now, even with Coinbase, for example, starting to build out their L2 base. A lot of the applications that are going to be built on that are going to be very very easy for the user, the end user, to actually use, to access, to feel comfortable using it in the same way that you might feel comfortable using Web 2.0 apps. And so what I'm really excited for is, over the next year, over the next 2 years, it's going to be a lot easier for retail to access DeFi and have a better experience using these products. And as an institution, right, Golden Tree is a large regulated institutions. When people say, "Hey, where are the institutions?" It's kind of us, right? Coming in and actually using these products. And I'll say that we've had a lot of conversations with DeFi protocols that are building in areas that will help us unlock liquidity for our own assets, for our own investments, for things that we are doing. And we're looking at, again, things like what Jason was talking about, like what JP Morgan's building. But even in the decentralized space, there are now products being built that have KYC attached to them. And one important point here is that a large reason why we haven't seen uptake in DeFi from institutions is actually because of regulatory clarity. There just hasn't been. And right now, we're pushing forward full steam ahead. There are hearings right now going on about crypto. There's pro-crypto legislation that's being drafted. The SEC is finally being pressured by courts to provide clarity on things like GBTC, which I think over the next year or so will extend out to DeFi. And so once you get that clarity, then you can start to build products that institutions actually feel comfortable using. And I'm very, very confident that in the next 18 months, we're going to start to see that regulatory clarity. And if we don't, that just means that people are going to start going offshore. But I'm confident that in the US, we'll be able to figure something out.
Yeah, I think just riffing off of that and what Steve said about rising interest rates, I believe that is actually a good catalyst for DeFi and our space as a whole, because it's a forcing function of, looking at some of these real world assets like T-bills that have, fairly high returns for safe returns. And so that is giving us more of a focus on building out those bridges between these treasuries, let's just call them, and because of that, other types of assets that Jason and others are looking at to tokenize, and it's causing a boon for this space. And in terms of institutions, I would say that there's still a large pool of assets from institutional crypto companies, layer 1 protocols, layer 2s that have large treasuries. They don't want to earn yield off of a native governance token that they have to sell in order to get that double-digit returns. So if you can figure out a way to have good risk-adjusted yields that they can feel comfortable putting in their institutional treasuries into everything on chain, going through KYC, that is not going to take a lot of time and a lot of friction. I think that's a major unlock that the industry can see. And the kind of forcing function was this negative event for risk on assets, right, of increasing interest rates.
Yeah, I think that's a really good point, Ida. It's almost like we're at a place in the world where we've gotten to a place in society or civilization where the appetite for an understanding for the appetite of lending and borrowing against one's valuables is like greater than the intangibles of things that you can't touch or feel, like we have seen in crypto the last 5 years, right? So I don't know why I'm going to use this example, but think about the boon that the baseball and basketball card industry has seen the last decade, right? Someone has a Patrick Mahomes, rookie patch autograph graded 9 by Beckett. It's worth $500,000. There's like a very liquid market for that, right? There's no current infrastructure rails for anyone to borrow against that card in any type of like seamless way like we have with Aave or JPEG, Drops, etc. So if you actually create financial infrastructure and have kind of that real world to on-chain connection, and so, the people that own those things are willing to pay 8, 10, 12% interest just to borrow USDC at 30, 40% LTV, and things like that have enough price history, and Chainlink does build oracles based on real world data points that end up creating this like beautiful confluence of like the on-chain off-chain world. And I think that is where we're going to start to see a lot of demand and interest in supplying capital for people to borrow in ways that we've never seen before, because there hasn't really been a uniform way for people to do or to access capital for the wealth that they have in things that are other than money and real estate. So like I think that's the next big boon, I hope, theme.
Do you think, I guess the follow on from that would be, and it kind of goes back to what I was saying before about some new stable coins coming out the woodwork and whatnot, but with more of these platforms and I guess kind of like better liquidity for the underlying collateral, wouldn't you expect those rates to kind of come down a bit over time?
No. Well, maybe sometimes on like real financial instruments that we tokenize, yes, the rates will come down. Like I think someone was talking about treasuries and stuff like that. When those are tokenized, rates definitely come down. But
no, I mean for like borrowing against NFTs, that kind of thing, right?
Well, so Patrick Mahomes rookie patch autograph, definitely not an NFT. Maybe the NFT that exists related to that is just a redemption ticket to pick it up at your local bank, right? Or your local safety deposit box. So that is like a different world where we actually haven't had access to capital for those types of assets before, right? So you're on one hand, tokenizing existing financial instruments is great because yes, rates come lower, but it's almost like the rates are infinite for these things that haven't had rails to access capital for. So the rate at which people are willing to borrow against that asset should start pretty high, which is what makes it appetizing to potential capital providers, because hey, if I borrow against my Michael Jordan, precious metal gem from 1997, I can make more than 10% with that money that I'm borrowing. And the lender should be very happy to lend me that at 30, 40, 50% LTV, because there's a very liquid market for high-end collectibles. So I think that there's like a middle ground there where rates will come down, but also, rates will be established. Does that make sense?
Yeah. I was just going to say the interesting point that Jason's example brings up is, one of the reasons why I think call it like the original RWA thesis, security token thesis, didn't take off was the infrastructure available to kind of prove custody off chain, the liquidity necessary for institutions to come in and actually make markets in those assets wasn't there. So there's this fallacy that, if you listed a security token on, I think there was one exchange at the time, I'm blanking on the name of the exchange, they ended up winding down. But if you listed it, that it would unlock this liquidity premium for an otherwise illiquid asset. And the fallacy was that, listed doesn't mean liquid, and there was no volume on that exchange, so they had to shut down. But on the custody side, what's really interesting for the future and an opportunity is ZK technology and the use of ZK for verified credentials. So imagine you're the holder of that, Patrick Mahomes card, and you're holding it at a bank off chain, and that bank actually provides a verified credential that you can now hold in a data backpack in your wallet and say, I am the owner of this asset, not just some on-chain representation that maybe could somehow be a misrepresentation of actually owning that asset. And in addition, I only have to share that verified credential with the application, call it the NFT finance application that I'm trying to use to borrow against that asset. So people don't need to see that I hold it publicly on chain, because I can have a privacy preserving verified credential within a data backpack in my wallet. Which I think is really interesting.
That's super interesting to hear you guys talk about this, because this is literally what I was doing for about 8 months before I came on at Sushi for a multi-billion-dollar precious metals firm in the US. And so this stuff, I think, has been happening kind of, I want to say, for a while. I actually got into crypto in 2015, 16 because of ZK Tech and what it enabled. So to see it kind of come full circle and be something that you guys are seeing as a new or a renewed avenue for increased capital inflows, I think is really exciting. And I like both those examples quite a lot. And Mark, I agree 100%, because that's what I was doing. And that's one potential client that had a massive appetite for it, so that they could unlock, the liquidity that those assets could provide. So really interesting.
Yeah, and just one point on that with ZK, is the other piece that everyone's talking about, institutions being able to participate in DeFi, needing to understand that the counterparty that they're trading with is not, some Spanish entity. And so Chainalysis keeps an on-chain list of wallets that have been kind of flagged for sanctioning. But you also need to know that this investor maybe has the ability to trade in this asset and the correct licenses. And so now you have ZK, ZK Tech attached to a wallet that says this person is an accredited investor, this person is a qualified custodian, whatever it may be. And also, again, it's private; it's not for everyone to see, except for the protocol that wallet needs to interact with. So this is going to allow institutions to bridge into DeFi from CeFi, which I think makes DeFi infinitely more interesting, because the vast majority of liquidity is coming from large players, not just retail.
Right. Let me play devil's advocate for a minute and ask if there's any concern that kind of reconciling these institutional approaches to building new, inflow rails, because we talked a little bit about KYC maybe being a requirement for bigger amounts of liquidity from institutional players. Do you think that creates an environment where maybe the liquidity becomes siloed away from the rest of the market, where not everyone is going to comply with KYC requirements within DeFi?
I think that's a big risk. Go ahead, Jason.
If you think about real world assets, and the demand for liquidity to borrow against those, whether it's financial instruments or collectibles or whatever it is, it fundamentally requires some form of KYC, right? On both sides, right? You have an item, you need to place that item with a company or custodian or whatever to give you that NFT to then use that NFT to borrow money, right? You can't just have a piece of art sitting in your house and someone's going to randomly trust you that you're not going to sell it while it's an NFT that you're borrowing against on DeFi, right? That doesn't work. So for you to even as a user be able or want to enter this market, you have to understand that to get access to this liquidity for the value and or your wealth that you have in these types of assets, you literally must KYC. So I think there's a jump there. There is some degree of, okay, we don't have to, we can stay completely anonymous to the rest of the world, but in terms of me, the user, to the provider that's actually allowing me to use these rails, there has to be that, whether it's zero knowledge proof trust or just, face-to-face trust, it has to be there, or you wouldn't be able to get the access to this underlying product or capital, So it's kind of like a shoe-in. Does that make sense to anyone?
Yeah.
I think
Go ahead.
And postulated by most of the panel. I do believe that permission DeFi is a big theme, especially for 2023. But I think this optimistic view that we are going to marry institutional grade compliance standard with code enforced transparency. I mean, it's very much a possible world that we're going to be in, but it's also possible that trying to do all the KYC AML is going to burden a lot of the protocols that currently exist, and there's still the risk of smart contract liabilities and other issues. So I mean, if this stuff is done well, I think it's absolutely going to open up a great future for the space in DeFi, but it's not a guarantee at this point. And I think we're at a really critical juncture for trying to figure this stuff out. That said, I think some of the demand for some of this stuff, like the marketplaces, are underdeveloped, but where we're different from what it looked like back in 2017, for example, or 2015, in terms of permission DeFi, tokenization, all this kind of stuff, is like a lot of the big entities that were already kind of mentioned by some of the people on this panel. They're all doing this incremental part to build out the infrastructure here. Like, I would have never imagined that intraday repo could have been a thing, but it's only possible because of blockchain technology, for example. Now, granted, that's running inside of a private blockchain, inside of JP Morgan's like Onyx network, but that is slowly being used, and that creates the funding markets necessary so that you can turn over like cash versus treasuries in a 3-hour time span rather than having it be T+2. So things like that, I think, are developing and kind of keep us from moving backwards in time. I'm just kind of want to be pragmatic as far as talking about this stuff, because it's not just all like sunshines and roses. I think it requires a fairly thoughtful approach.
Let's talk about the dark side. Actually, I did kind of want to segue from that a little bit, but we're talking a lot about the tokenization of real world assets and kind of the entrance of retail investors or a plethora of more use cases that would bring more retail investors into our space. That then kind of brings up, the traditional sense of things where institutions controlled a lot of the regulation. There, I said it, the big R word. Curious, given the changes in regulatory environment over the last year, the last few years, what can we kind of expect in the next year? And in what ways does that create potential challenges or opportunities for investing in this space and for the space in general that you're seeing as investors?
I actually, before we jump into that question, I wanted to ask David a question, because that's kind of where I was hinting at when I was saying let me play devil's advocate for a minute, in follow up to that, and say, do you think it's maybe more optimistic to view these iterations as ways to iterate towards a more frictionless environment between the two without melding them directly together at the regulatory level, so that someone who maybe globally uses Sushi Swap, for example, in the Seychelles, all right, doesn't need to comply with the regulatory and KYC AML requirements that are imposed at the US regional level, but that liquidity exists on chain and doesn't have an onus to KYC once on chain, right? Like, creating less friction to me is where we serve, like at the protocol level, users better, and complements building out a more usable protocol at the UX level. I don't know if you have a thought about that, or if maybe I'm totally off base, or just kind of what you're thinking.
No, that's exactly one of the challenges that I think of when I think about bridging over a DeFi protocol targeted towards retail investors towards institutions, because then you run into many of the geopolitical, also legal kind of issues surrounding jurisdictions. How does that work? It really needs to have, it needs to be done differently in order to be able to kind of cross over, so that, where does a certain law kind of take place if you're in a region? And for the most part, I don't even think that in traditional finance, we've solved all of those issues. But I think we often believe inside of the crypto space that the code can solve that problem, and it can be written. And in some cases, that's true to an extent. But I think the practical challenges still haven't been fully thought of yet. I think we're on our way towards that. But certainly, we got to figure out. And I think Avi kind of said it about the regulation. I think the way we figure this out regionally, and there's been a lot of amazing progress on the side from the point of view of like the UK now kind of putting this inside of their current existing framework for like other financial instruments, for example, or how Mika kind of operates, or what's going on in the UAE and how they're like treating like virtual asset service providers. I mean, like all this stuff, I think is building to an extent where like, you know, in the US, which has been arguably somewhat more behind when it comes to this stuff, I think they're realizing that if they don't act fast, there's going to be the risks of our regulatory arbitrage, and everyone else is kind of moving ahead. Like, it's not a security issue yet, but it definitely could become one in the future. Now, that said, I think there are some optimistic elements, you know, like for DeFi specifically, you know, we have the CFTC, like Technology Advisory Committee meeting coming up. I think that's on March 22nd. Like DeFi is like at the core of at least like the first topic they're going to be talking about when it comes to this. So, you know, it kind of shows you that there is some direction when it comes to the US regulators. We've pretty much made our position clear from Coinbase's side about what happened with, you know, Kraken and Paxos and the custody proposal from the SEC. But it kind of shows you that like there is, even among the regulators, a lot of differentiation in terms of what people are focusing on at the moment.
And I think that they're also going to be posed with like new questions that they haven't faced before, right? I know that forget what some of the names of the platforms are, but like I think like Alt or the other like Masterworks, things where Web 2 clearly went the securitization route, right? But what is that? It doesn't necessarily translate that way for Web 3, in my opinion. Like if let's just say, you know, I'm a JP Morgan Chase client, and they're willing to, you know, mint me an NFT on their, you know, enterprise Ethereum fork for my Patrick Mahomes, you know, RPA rookie card. Like that isn't a security. It's just it's like a coat check ticket for a collectible, right? So, or is it a security now because that asset now has access to financial instrument rails? I don't know. The government's probably going to pull something out of there, something to say we feel this way about it or that way about it. And I really don't know. But it's an interesting question because it kind of calls into question the parameters of how we actually deem things securities, right? Like I'm the first person to say, especially at this point, like, sure, I'll, you know, KYC if I want access to, you know, cooler, better, you know, more, you know, free flowing liquidity or capital for certain things that I'm not otherwise able to get access to, right? But you know, that's not going to solve the regulatory problem, right? And it's going to really be on our government or the US government to step up and say, all right, we actually understand and see these differences between what Masterworks is doing, what Alt is doing, what, you know, these real world asset NFTs are doing, and make some decisions, because that's really what's going to shape this kind of industry and the tokenization of real world assets and how they're used in DeFi.
I think Brian Armstrong was just on the Odd Lots podcast, and you know, they drilled him a lot on regulation. And what I gathered from that conversation was basically, you know, if Brian Armstrong isn't really certain where the regulatory environment is going, and you know, Coinbase is so deeply entrenched in these conversations, and David, you may be privy to them. Like, you know, we're many of us are investors in the space, you know, venture investors, and obviously the regulatory environment is important, but I'm not going to be the one that's accurately, you know, pontificating on where the U.S. government's regulatory regime is going with regard to DeFi. You know, the lawyers are going to do that, and the regulators themselves. But
there's one
small excitement about opportunities in the space, and there's plenty out there to talk about.
I think there's one small distinction that I like to make when it comes to these systems, and that's that there really, I mean, two reasons why DeFi and why blockchain tech is so powerful right now in the world of finance and kind of everywhere, is that on one hand you have these closed permission systems that exist among banks that banks are trialing, that institutions are using. You have these like KYC walled gardens, and then on the other hand you have these open permissionless financial rails that could be used globally for global liquidity, as people were talking about. Like somebody in Cambodia can go trade with somebody in the US with zero friction in less than 5 seconds, right? And so these two things are actually going ahead in parallel right now. They're both being built out. And I think if you look forward a year, you're actually just going to see these two parallel systems that some people on the permission side may open up and allow those assets to flow to the permissionless global liquidity pool, or some people, maybe JP Morgan says, okay, like all of our assets are only going to be interoperable with our own systems. Now, people look at that and they say, that doesn't make a ton of sense, but it actually does if you think about, well, the current systems that exist in TradFi are pretty broken and very old. They were all built 50 years ago at this point. And things can go wrong. It's like a bunch of like duct tape over duct tape over duct tape, which is why there's so much innovation happening in this place. That's why if you talk to Nomura, for example, they have 65 people on their digital assets team. It's like, okay, well, why? It's like, because they're building that out, right? Why does JP Morgan have 500 people working on blockchain tickets? Because they know that these systems don't work right now. Now, unfortunately for all of us, and probably for everybody listening, there's kind of no way to like make real money on these things other than investing in VC for people that are building exclusively for banks, because the majority of money that's going to be made is just cost savings for people like large hedge funds and banks. That's just all cost savings. But what it does is, because they're right now building out these permission systems, these KYC systems, they're actually still building it on some form of permissionless system. So JP Morgan's underlying chain is built on a fork of Ethereum, for example. So what you see at some point is that there are like these small steps that are being taken to build systems that can become interoperable in the future. And so the goal is effectively for us and for everybody that believes in that open permissionless world to go focus on building that side of it. So go let Sushi go build out everything that it needs to in order to become the global liquidity provider for the permissionless world. Maybe they just don't touch the US for the next 3 years because regulatory clarity is not clear. But then by the time people are ready, well, these rails that have been built by banks can be modified to go actually interact, where in a way like today, that's just not true at all in any way, shape, or form. And one additional point that I'll make around the tokenization of assets is the most important part of tokenization of assets is not representing assets on chain. That's not it. Because there's one world where you have a bunch of mortgages that go through and you package up those mortgages in a legal framework, and then you put them in an SPV and then you tokenize them. And that's kind of what's happening right now. The most important part of tokenization is getting those assets issued on chain, not represented on chain, but issued on chain. So that's what is really going to change things. And that's what's really going to cause cost savings is, hey, when I go get a mortgage, and when mortgages get securitized, all of that happens on chain directly. Like the directory for it exists on chain, right? If a public company goes and issues debt, they don't go issue debt through the rails and then put a bunch of debt in an SPV and then tokenize it and then borrow against it. No, they're issuing it on Maple, or they're issuing it on Credix, or they're issuing it through these other platforms. And so that's kind of when I think about personally investing in this space and putting capital to work in this space, that's what I'm looking for. I'm not looking for a wrapper. I'm looking for, okay, who understands these systems, who can rebuild the systems from the ground up, and who can issue them in an interoperable way, right, from day one, and actually represent these systems. And then you sort of like bucket them into two categories. You bucket them into okay, these are the institutional guys, and okay, this is a global open permissionless system. And I actually think, again, to repeat myself, those two things are going to exist in parallel for some amount of time before they start coming together. But both of those things are valuable, right? It's not like one is valuable and the other isn't. Both of them are valuable, and they're just going to exist in parallel.
Yeah, Avi, I do think that there's a little bit of a mixture of the two currently. If you look at Maker, for example, and review their year-end 2022 statistics, their total assets have dropped, from about 10 billion to 5 billion from the beginning of the year to the end of the year. But if you look at the amount of RWAs across players like Fortunify, Centrifuge, and others, and T-bills, as we mentioned before, it's grown from virtually zero to about 600 or 700 million. That's a small drop in the bucket in terms of the general Web2 TradFi space. But in terms, if you look at the relative change in growth rates, it's significantly high given what we have in Web3. And I would say Maker is one of the most is one of the largest and one of the oldest in the space. However, if you also read through their report, you'll notice that they do have they have called out the issues, right, of being able to use on-chain governance to cater to conflicts of off-chain issues, right? When you liquidate these real-world assets, it will be easier if you have everything on chain, as you mentioned, Avi. But I think we're slowly starting to see the merging of the two worlds. And I agree with Mark when he said, back in the day when people were just tokenizing real estate and thinking that would lead to a lot of liquidity, it didn't really happen.
Mhm.
But there's ways to transform these assets in a way that will cause more liquidity. Maybe people don't want to trade real estate, but you can collateralize that real estate and mint stable coins like what DAI is doing, and that would have more liquidity, or create synthetics off of that. So I think there are kind of smaller steps that we can take to increase the pie for DeFi while tapping into the real world space.
It's all education. It's all education. Literally, like growing the pie at this point is education, because the assets are there. It's the education that's required, because once the big institutions get educated, like the Point72s, the Apollos, etc., that's what's made them get interested in lending dollars at high interest rates against items that have been tokenized, right? Or RWAs that have been tokenized.
We spent a lot of time on RWAs, and I think that I would love to bring attention to, I think the reason people are excited about RWAs is because these are inherently productive assets.
Mhm.
They produce yields, right? They produce cash flow. And I think what's really interesting moving forward in 2023, and if you look at kind of like the winners of early 2023, it's productive assets that are crypto native. So, we have the Shanghai upgrade coming potentially at the end of March, probably, I think maybe early April now. Some of the best performers of this year have been liquid staking providers, LSPs like Rocket Pool, like Lido. And, the reason why ETH is now, this incredibly productive asset is because it actually has utility, providing security for the Ethereum network, and users are generating, passive 7% yields in some instances by providing that security to Ethereum through proof of stake. And I think what that's going to unlock with this kind of new base productive asset in DeFi is really compelling. So Eigenlayer just released their white paper. I think even once ETH is staked, like it's still something like 60 or 70% of all staked ETH is not even reused in DeFi. So that kind of removes the benefit of superfluid collateral. But now with Eigenlayer, you're going to have at the validator level the ability for ETH validators and stakers to restake that ETH towards different useful applications and to earn an incremental yield for those for securing those applications with the staked ETH liquidity. And what's going to come from that is different sets of validators with different risk return profiles that are, again, producing cash flows by providing security to these different applications. And I think we'll see tranching of credit risk based on different validator sets. And I think we'll see liquid staking providers that are launching Eigenlayer type competitors, the Lido high risk staking index, which is a set of validators that have rehypothecated ETH across 3 applications, or the Lido super secure index, which is maybe only earning 3%. And it's a senior tranche of, more secure validators. So while we're excited about kind of this RWA thesis, and we definitely are a mechanism, I think that, we are all crypto native, we believe in open permissionless systems, and it's cool to see what's happening with crypto native productive assets that can generate real cash flow for users, and what's going to come from that.
Very well said,
I think
Mark.
what you're saying isn't altogether inconsistent from what Avi was saying, for example. And, just to kind of make one point about what Yida said on RWA, like, yes, your numbers were right in terms of the RWA that was locked up on Ethereum, except that we actually went higher above those numbers. We were at a peak of like 1.75 billion back in like Q2 2022. before we came down to that 600 million, 700 million kind of figure that you quoted. Which to say that, you know, in some ways, like a lot of this stuff is still kind of cyclical. So it's not as like a, you know, it's not necessarily a secular trend that we're seeing as far as like the numbers that are and how sticky they are. But I do think that the move in terms of RWA, in terms of what Avi is saying, in terms of what Mark is saying, like this is why I find it so difficult when people are asked like, hey, what's your favorite protocol? What's your favorite project going on in crypto today? Because it's all of it. I mean, like you kind of need, for example, EigenLayer and what it's doing for middleware in terms of like what that's going to do for higher yields that can be earned by validators. You need decentralized identity so that many of the people who are working in this space can actually utilize it and actually make the markets necessary for RWA to bring the stuff on chain. Like it doesn't operate. None of this stuff I think operates like in isolation. Like it requires everything kind of working together to kind of make this work. And that for me would be the secular trend that actually pushes us all higher.
Wow.
New world order.
New world order. You heard it here, folks. I think, you know, thank you guys so much for being here today and, you know, sharing all of this big brain energy with us all. I know we could definitely keep this panel going for probably another couple days if we really wanted to, and I'm sure we definitely can. So maybe we'll set something up in the future, some Twitter Spaces, maybe some rough and tumble. Everybody put on boxing gloves too, and duke out your thoughts too. But thank you all so much for being here, and we are very appreciative to be partnering with all of you to keep building this ecosystem. And then, yeah, thank you.
Thank you for having us.
Thanks for having us.
Thank you. Take care.